Welcome to Lesson 8, Part B. We're going to talk about the risk-return trade-off. Let's first have a look at the real-life system combination encompassing the 4 trading systems discussed so far. The first page of the risk scorecard features the historical drawdown estimate and the standard deviation estimate related to the annual time series. The latter indicated that sigma is the estimate involved in the risk-return trade-off. We assess, in fact, the risk-return trade-off by means of the Sharpe ratio, whose abbreviation is SHR, which is reported at page 2, and which is defined as follows. The system return minus the risk-free rate divided by the system volatility expressed as the standard deviation. All said estimates are annual estimates. In this formula, we denoted with RF the annual risk-free rate. The 1-year maturity treasury note can be taken as a good proxy for said rate. As this yield varies across the observation period, we employ its average value in the Sharpe ratio formula. This average value is indicated in the scorecard as well as the Sharpe ratio estimate. Well, according to its definition, the Sharpe ratio tells us when the system returns compensate for the system volatility. The bigger the Sharpe ratio, the better. But now we have to tackle the bold question: how big the Sharpe ratio must be in order to be satisfactory? Values around 1 are optimal. Values even higher, let's say about 1.5, are indicative of a standing performance. Let's have a look at the real-life example. The MASASP 4 system combination hits on a very good risk-return trade-off as its Sharpe ratio stands slightly above 1. The Standard & Poor's, which is the most performing stock index in history, is much worse, being characterized by a value smaller than 0.5. Actively managed ETFs, having the US stock market as a benchmark, still have Sharpe ratios below 1. And these ratios downgrade further if management expenses are taken into account. Hence, acknowledge the fact that the MASASP combination we are looking at delivers a remarkable performance in terms of risk-return trade-off. Besides, its performance becomes even more remarkable if we switch our focus on the negative volatility. In this chart presented in Lesson 1, the profit and loss distribution of the winning trades is taken separate from that of the losing trades. The latter is reported on the top. The volatility that is indicative of the risk of the investment is just that referred to the losses. Hence, we focus on the top chart. The losing trade return distribution is definitely thinner than that of the winning trades, meaning that the negative volatility is smaller than the overall volatility considered so far. Now, how to calculate this negative volatility? We just take the standard deviation of the topmost distribution and we adjust it by a multiplication factor of 2 because we are focusing on just a half of the profit and loss distribution. Beware that we are not talking about the trade profit and loss distribution. We refer to the annual returns of the system, and each annual return stems from the aggregation of quite a number of trades. If we took into account just the historical data aggregated at the annual level, we should handle the data unavailability issue, meaning the possible lack of negative returns. In that case, it would be possible to resort to a semi-annual estimate, adjusting it by a multiplication factor. If even at the semi-annual level negative returns are unavailable, it is possible to refer to the quarterly estimate, adjusting it through another factor. At any rate, in MASASP, we got rid of this complication, resorting to the Monte Carlo simulation-based estimate. We can give it for granted that we have some samples with a negative return across a set of 1,000 samples. We denote the standard deviation of such returns with CMCP, with the symbol minus within brackets. That is the negative volatility that we're going to use in order to refine the Sharper ratio estimate. Here it comes to this refinement. We similarly denote with the symbol minus within brackets the Sharper ratio based on the negative volatility. The risk scorecards reports both the regular Sharper ratio and the refined one. Due to the absolute return character of our system combination, the negative volatility is smaller than the overall volatility. Then the refined Sharper ratio is bigger than the regular one. That means that our system, already deemed as optimal, turns out to be even better. All indicators, except the refined ones suffixed with minus, have the volatility estimated based on historical annual data, without resorting to the Monte Carlo simulation. The Monte Carlo simulation comes into play just when the negative volatility is involved. Well, that's all for the time being. Thanks for watching and see you at lesson 9. There, we will complete the risk metric module.